All right, welcome everyone. Special thank you to the Nonprofit Resource Hub for hosting us today. My name is Mike McClay. I'm the Senior Business Development Manager with 501c Services. Feel free to introduce yourself in the chat. This is a lunch and learn style webinar. So we did provide Uber Eats vouchers to registrants. We did have a slight issue with the Uber Eats vouchers. We actually had a large amount of fraudulent registrations that looked like they were generated by AI. So unlike usually we batch send these out, but we had to send them out individually and manually. So if you already got a few emails, if you did not get your Uber Eats voucher, we apologize. Simply, email me or let me know that in the chat, and I'll have my marketing team send one out. You may not get it after the webinar, but I just want to make sure that you do get the voucher in case you were missed because we had to send these out by manually entering it. So that's the first. Been doing this webinar and this type of webinars for 10 years. So something to look out for with regards to AI. So today's webinar is regarding New York nonprofit's alternative to paying unemployment taxes. I've been a little bit about me. I've been doing this for over 20 years, both within the HR and insurance industries before coming on board with 501c services last year, and focusing all my attention on different ways nonprofits can fund and manage unemployment insurance and separations. So today we're just going to give a broad overview in terms of how unemployment works, a little bit about the history of unemployment. And if you look this up, you'll notice that we're a California company based out of Silicon Valley, but I live and I sit in New York. So we had some nice spring weather and now it's a little chilly. Hopefully the spring will come back. So today, again, we're going to talk about, again, broad overview of how unemployment insurance works. And then we're going to go into a 501c3's alternatives to unemployment insurance. We're going to talk about that a little bit. Right? And then we'll show some examples of how it's worked for other organizations that we've worked with specifically in New York. If you happen to be in this seminar and your organization is not based out of New York, a lot of what we're going to talk about is similar in other states, and we'll get into the differences later on in the presentation. And at the end, I'll take questions. I'll make sure I leave time for that. So if you have any specific questions and you'd like to put them in the chat, let me know. And of course, I'll have my contact information on a slide up at the end of the presentation, so that if you're not comfortable putting it in the chat but want to reach out to me by email, you can send your questions by email or reach out to me directly, and I'll be happy to help you. All right, so let's start with unemployment insurance explained. So this is a little history in unemployment 101. So, if you think about the history of unemployment back in the 1930s, unemployment benefits began in the United States as a way to provide some security to American workers if they were laid off from their job. But this is only available if you're an employee of a of a for-profit organization. If you're an employee of a nonprofit, uh, unfortunately, unemployment was not something that was available to you. So it wasn't until 1972 um, that 501c3 organizations that were previously exempt were under Roosevelt's New Deal, right, were actually allowed to give them the opportunity to participate in the unemployment tax system, right? And this really gave an opportunity for nonprofits to participate again through the tax system, or they had an option to participate by funding their own claims, so that the idea was they didn't have to bear the unnecessary expense of the tax system. So a lot of nonprofits are not aware that they have any other option outside of paying unemployment taxes into the tax system, that they can actually choose to fund their unemployment in alternative ways, such as reimbursing the state dollar for dollars for their actual claims. And I'll just stop right here just to respond to a few things in the chat. Yes, we'll make sure that everyone gets a copy of the PowerPoint, as well as can send an email from the Nonprofit Resource Hub as well as directly. And we'll make sure everyone gets a copy of that. And I'll send links to our YouTube channel. Typically, we post our seminars up on YouTube and our social media so they have access to the recording after the fact. Also, I neglected to give a little bit of legal preamble. So, and this is our attorney requires us to say this. So, unless presented by an attorney, nothing in our webinar is considered legal advice. The content in this webinar has been pulled from multiple sources, and 501c Services 40 years of experience and expertise in helping nonprofits manage unemployment. All right. So let's talk about and go into a little bit about how unemployment works in New York. So unemployment is overseen on a federal level. However, each state gets to manage their own programs however they choose. So throughout the US, you can see different taxable wage bases, tax rates, benefit amounts. And today we're just going to cover what it looks like here in New York. When it comes to management, unemployment rates can be adjusted annually and they are adjusted by experience. So, for instance, if you have 1 or 2 years of bad claims, which means significant claims frequency, your tax rate will increase. Most states, including New York, run as a risk pool. So, what you put in does not necessarily equate to what you get out. And a lot of nonprofits are putting more money into that pool than they're getting out. These total tax liabilities by employers are often greater than the claims paid. So, if you think about how your general liability or workers' compensation insurance works, usually those programs are underwritten based on your performance, both from your claim standpoint, how you manage risk, and your financials. But when you're in the state tax pool, there is one component that does consider performance in your costs in terms of how many claims you have. But generally, it's run as a pool, so you're subject to the performance as a pool of the pool as a whole. So, if your claims are significantly less than the average nonprofit in that pool, you're going to be paying more to subsidize the claims for those other organizations that are in that risk pool. And I want to get that a little bit later in the presentation. I'll show some examples of what that looks like for a nonprofit. So a little quiz. Understanding cost of unemployment. So how much do you think a single claim in New York cost? So if you think about unemployment claims in the state of New York, they're paid out on a weekly basis, and there's a maximum weekly benefit in the state of New York. So how much can a single claim in New York cost, assuming that the employee collects weekly up to the maximum of 26 weeks? And I'll give a moment for a couple of for people to put their answer in the chat. Yeah, one answer 23,000. Okay. So 23,000, that's a great answer. And that's actually a difficult question right now in New York because it went up to 22,594, so almost 23,000. And that was actually effective October 6th. Whereas back in 2025, back in 2024, 2025, the maximum for a single claim used to be 13,104. And yes, there's a component that is salary earned based on time spent, but this is the maximum that a single claim could cost in the state of New York. So the maximum possible weekly benefit went up, and this has been a trend state by state in terms of keeping pace with inflation. And that's a careful point to consider with regards to the cost of unemployment. All right. That was very good. That's the first time I had someone from New York get that right. So fantastic. So here we have on this slide this characteristic unemployment in New York and how it works. I'm not going to get too in the weeds, but I'm going to give a broad overview. So the maximum weekly benefit in New York, as I said, went up from 504 to $869 per week. And we multiply that by 26. That's how we get to the maximum benefit of 22,594, right? So assuming that salary and time spent at the organization, they get the maximum amount. That's the most amount they can get, right? It's important to know that New York has recently paid off as of last year, nearly $7 billion in unemployment insurance debt. So for many years, the New York State unemployment tax pool was running insolvent, and that meant they were borrowing heavily from the federal government to be able to continue paying out unemployment benefits. So in order to avoid having to pass on what they call the interest assessment surcharge, which we no longer have to pay anymore, they paid off the $7 billion in unemployment insurance debt. However, this is something we have to watch closely is because it follows that if they've increased the maximum benefit and they've paid off their debt, that in order to keep pace with inflation and and avoid insolvency in the future, New York must increase taxes and the taxable wage base to keep pace. So if you look at New York specifically, historically, the wage base, has increased year over year. So right now that wage base is 13,000. And what that means is that's the amount that an employee's wage is taxable for unemployment. So let's say your rate is 5%. You pay that 5% up to that wage base for each employee. So once an employee hits 13,000 in the state of New York, they pay that tax on that wage base. This is why typically you'll see if you look at your quarterly returns and payroll and your tax paying, your unemployment taxes will be largely paid in the first quarter and will decrease as you get to your second, third, and fourth quarter. One part of this that makes it expensive for a nonprofit organization, and in my ass, I actually used to work in the past, I worked for a disability service provider. I also worked with adults with mental illness and chemical addiction a long time ago. So within these organizations, typically there's a lot more turn and moving parts. So those organizations have typically much greater unemployment expense because they turn that position more frequently. So we'll see that a 200 employee human services nonprofit will have a much higher unemployment tax expense than perhaps a 200 employee law firm that has very little turn within the organization. So that's why a lot of the times unemployment tends to be more expensive, especially for your service-based organizations. And you'll see here that in New York, uh, the minimum tax rate right now is 2.1. And again, that's performance based, all the way up to a maximum tax rate of 9.9%. So based on your performance and your claims, New York will increase your tax rate or decrease your tax rate to a minimum of 2.1 based on how well you do in terms of what kind of claims are coming out of your organization. All right. So just to review, taxable wages in New York have been going up slightly, about $200, $300 per year. We're looking at it and looking at it very closely to monitor for changes. But generally, the last 10 years, we've seen an increase of 20% per employee. Some other states, like in Connecticut, for example, last year they had a huge 40% increase in their taxable wage base, and other states have followed suit. So the overall theme is that when you get your tax rate notices that come in February, it's something that your organization should be aware of in terms of what their tax rate is going to be when they're budgeting for next year. And later on in the presentation, I will share an example of what that tax rate notice is and how you can interpret your tax rate notice. One last thing that I wanted to mention is that last number, which was at the bottom here, the improper payment rate of 25%. So the improper payment rate of 25% is the overpayment in terms of overpayments due to fraud, as well as overpayments due to claims that were not paid out appropriately, people who were not really eligible to collect. And that equates to 25.09%, which is over $2 billion in overpayments over the past 3 years. So this is information that we get from Department of Labor. And you see New York is one of many states that is greater than 13% in terms of its overpayments. These are the states where we typically see more organizations choose to reimburse because of the expense and difficulty in managing unemployment. Um, so New York Department of Labor, for example, reported that it overpaid benefits to the tune of 425 million between 2020 and 2023. And two-thirds of that number was due to fraudulent payments. So when you talk about fraud, one of the things that I saw was actually with a new client of ours where the CFO that I was dealing with actually received a claim of unemployment through their HR department for that CFO, who obviously was gainfully employed and was not getting let go and was sitting with me on the call. But that's an example of how identity theft and fraud is being perpetuated, and AI has accelerated this and given bad actors the means to try to extract funds from the unemployment for, either separated employees, even employees that are at your organization. And part of that is the onus is on the employer or the organization to vet claims of unemployment as they come in. So what happens is an employee goes to the state of New York and puts in a claim, and then a notice comes to you as the organization. So it's the really the burden is on the organization to vet that claim of unemployment in terms of, are they eligible to receive that claim, right? Is that charge protestable? Were they fired for cause? Did they walk off? Or were they fired for disciplinary reasons? There's certain circumstances that may make that individual ineligible to collect unemployment, but as well as verifying that that employee was indeed an employee at your organization, right? And or is indeed make sure that they could even be still employed at the organization. So we've seen that in the past. Once claims of unemployment are paid out, it's very challenging for the state to recover those funds outside of garnishments. So it's important that, and we really encourage our clients and organizations to really look over their claims and make sure they're not overpaying. So here at 501, my organization helps nonprofits do this. Over the last 3 quarters, for example, just looking at the state of New York, we've seen over $100,000 in credits that we've gotten back for our clients from previous overpayments via our claims management and internal audit process. So if you are managing your claims on your own, you want to make sure that you're properly charged for any former employee's weekly benefit amount. Okay, so now I'm going to cover some alternatives to being in the tax pool in the state of New York and show you some examples of what that looks like for a nonprofit organization. So essentially, it boils down to three options that a nonprofit has. They can continue to pay the tax and be in the state tax program, or two, they can choose to self-insure or reimburse. And there are many different ways a nonprofit can choose to become reimbursing. What that essentially means is that in the state of New York, you have until the end of the year, so December 31st, to let the state of New York know that I would like to be a reimbursing organization, right? So once New York recognizes that you've sent that notice that you'd like to be a reimbursing organization, that means instead of paying unemployment taxes quarterly, instead you get a bill. And that bill is for the actual claims of unemployment that originated from your organization. From the employee standpoint, nothing changes. So there's no disruption on the part of the employee. The employee still goes to the state of New York, either online, right, or over the phone to make an unemployment claim, right? And a notice then goes to the organization that a claim is received, where you have the opportunity to contest the claim. That claim is adjudicated by the state, right? So no difference to the employee whatsoever, right? But now instead of paying for the tax within the pool, you're paying for dollar on your own claims. And then the third option is to buy insurance. So, and the third option has only been out in recent years. There are certain carriers, and we even offer hybrid programs where you can self-insure, but we provide a trust program, stop loss, partial insurance, as well as more guaranteed cost type fully insured programs that take the place of the state tax program. And I'll get into those a little bit later in the presentation. So let me just go into, who's a fit for reimbursing and how reimbursing works. Okay, so the qualifications we look for consider for organizations should be reimbursing is one, you must be a 501c3 non-for-profit organization. This excludes religious institutions, although religious institutions can choose to be reimbursing. They have a different set of rules. They can actually have a certain class of employees in New York can choose to be exempt from unemployment. So that's an entirely different presentation. If you on this call and you happen to be a religious institution, certainly we can have that conversation. There may be some other options available to you, but generally you must be a 501c3 organization to be able to be a reimbursing organization. And that was set back in 1972 in the IRS tax code. So if anyone wants to take a look, you can send a copy of the tax code that states that you must be a 501c3 nonprofit to be able to participate. Generally, we recommend you have a gross annual payroll of over $1 million for best results. Typically, if you're under $1 million of gross annual payroll, we do have a few clients, and I have worked with clients that are less than $1 million in gross annual payroll. Typically, those organizations that are under a million that may participate in a reimbursing type program are the ones that have very few claims to no claims. The last time I did it was an organization with a $500,000 in payroll that had zero unemployment claims in 10 years. So for them, every year they're paying unemployment taxes was just a sunk cost. It's money you can't get back. But generally speaking, if you're under a million, it could be financially too risky to become reimbursing because you're paying out of pocket for your own claims as you go. And potentially you could end up paying more in unemployment claims than you would be paying in the tax system. Whereas if you're a larger organization, savings recovered over time, over 3, 4, 5, 10 years, far outweighs perhaps years where you might have more unemployment claims than you would have in the tax system. So the other thing we look for is a positive audit over the past 3 years of unemployment. So I actually had a conversation with an organization this morning that was looking to lay off several employees as of July of this year. And if you're tax paying and you're considering layoffs, we would not recommend that you exit the tax system. Because essentially, the tax system, even though it's a pool and you may be paying more in taxes in the pool, if you anticipate a significant amount of layoffs, the state tax pool will pay out on all those claims. So in that case, that organization was small. They were about 800,000 and they were anticipating 16 layoffs. So they were paying about $20,000, right? So I did see a question, what would be the unemployment tax cost of $1 million? It depends on your tax rate, right? In this case, the tax rate was, around 3%. So about $25,000, $30,000. And that was just an estimate, just having conversations on their financials. But their unemployment claims cost, because potentially they're looking to become insolvent and lay off anywhere up to 16 employees, could be over $100,000. So it would not make sense for that organization with that kind of volatility to consider being reimbursing. So that's something we look at before we consider, any conversation around how to reimburse or how to fund your unemployment claims. We want to make sure it's a fit. We want to make sure that there'll be a benefit over the long term for the organization to be reimbursing, right? And that's why we also ask, we look for any major disruption in funding that might be expected over the next 24 months, right? And certainly we've had reimbursing organizations approach us. So if your organization is already reimbursing, because of the increase in maximum weekly benefits, we have met with those organizations that looked at, hey, should we actually go back into the state tax system? And usually that's not the case. If you're a large organization, if you have 5 million or payroll or more, usually the savings outweighs the increase in benefits cost. Not all the time, but sometimes it's a matter of trying to figure out how can we better control unemployment claims cost? What are some better ways or that we can help fund unemployment more efficiently over time, right? So if you're a reimbursing organization, it's been a long time since you've looked at this. We definitely recommend that you take a look at your unemployment cost and make sure that that reimbursing is still a great option for you moving forward. All right, so we work with 3,000 nonprofits that are all reimbursing. About just over 100 of those are in New York. So if you probably figured it out already, but what really motivates nonprofits to become reimbursing is that it saves them money. On average, savings can be anywhere between 20 and 40% versus the state tax expense, right? And that's really the driver for most organizations to make that change. So reimbursing eliminates any concern as well as with regards to changes in state tax hikes that you cannot control. And ultimately, because you're, self-funding or reimbursing on your claims, the organization becomes a better steward of the dollars and how they're managing that program versus being in the state tax pool, which within the state tax pool, there's no support that's provided in terms of managing claims expense for the organization. So again, just a reminder, employees still go to New York State to apply. So there's no disruption for employees to be in reimbursing. So Because unemployment is managed by the federal government, the big picture is that reimbursing is allowed in all 50 states. So again, this is best for employees with over 1 million in payroll and at least 15 full-time employees. If you are on the borderline, again, we can certainly have a conversation. We can look at their circumstances. Again, I've done this for small organizations that looking at their history of their claims expenses, it's obvious that, they have very little turnover, right? You've seen some foundations and other nonprofits that have benefit for being reimbursing because, you know, year over year, they just have little to no separations. So again, the tax amounts that they're paying are just a sunk cost. So let's talk about the different ways and strategies you can use for paying dollar for dollar and becoming a reimbursing employer. So this, first is to manage your own program. So this can be risky with the highs and lows of unemployment. I've seen organizations that struggle with to contest claims that are contestable. So if you fire someone for cause, and you can make a case that that employee is not eligible for unemployment. It can be very difficult, particularly I find in New York, to navigate that on your own and even the time consuming in dealing with the state and their adjudication process. There's even a part where you have to participate potentially in a claims hearing and denying a claim when an employee appeals. So you really need to make sure in managing your own program that you have the HR staff with the expertise to support that process and manage it. Because especially if you're reimbursing, every dollar that's paid out in claims is money that comes out of your organization's pocket and begins to limit the savings of being a reimbursing organization. This is why if you look at outsourcing, so organizations like ours are very popular, and we've been doing this for over 30 years because we will help the organization manage every step of that process. Right now, I'm a big analytics guy. So in the state of New York, we look at the average success rate with New York organizations in protesting unemployment claims that are contestable. And the average right now for organizations that are self-supported hovers just below 35%. We actually contest claims and are successful at a rate of 89%. So if you consider, if you have $100,000 of protestable claims and you're only successful less than 40% of the time, you're spending, $60,000 more. Whereas you can contest, 90% of those, then only $10,000 is walking out the door. So we did everything we can from a diligence standpoint to manage, audit, protest, and manage that claims process to reduce that risk and to prevent overpayments. The third option is to do a hybrid program where you're working with an organization like us, right, and you're self-funding those claims, or maybe you're using our trust where we provide a reserve trust fund account that's owned by you, and that trust fund account is backed by stop loss insurance. You can also purchase additional insurance. So typically these programs allow you to buy insurance to protect against catastrophic loss. So for example, if you want to provide insurance so that at $200,000 in claims, insurance will kick in so that that limits your maximum potential liability. You can buy an insurance product that will do that. You just have to keep in mind that will reduce your overall savings and will eat into some of that. And we do that for organizations. So typically, if it does look like you're spending a lot more in taxes than you are having come out of New York's pool in claims, then we'll say, all right, maybe you could be a good fit for reimbursing. We'll model those options out. Hey, this is what it would look like if you managed it on your own. This is what an outsourcing model, if you were to reserve money in a trust, would look like. Here's what it would look like with stop insurance, as well as all the related costs. So we do a lot of that for our clients to consult up front. So we can, one, make sure that this is a good option for your organization, that this will work, make sure to reduce risk. Again, we don't want to talk anyone into reimbursing if it's not a fit and if it's going to potentially incur more risk, where the organization, again, will be stuck paying more in claims than they would be paying the original tax liability on the tax system. All right, let's get into some examples. So before I get into that, I just want to go into how unemployment is calculated one more time. This is my least favorite slide. I'm not going to go too deep into this, but just to review in terms of how the numbers work. In the state of New York, the based on and I'll show you some cost assessments. So based in the state of New York, so the taxable wage base is 13,000. So you'll be charged their tax rate on the first 13,000 of each employee's salary or hourly total payroll, unless that position turn, which is why if you have more turnover, your tax liability goes up. You'll see your SUI costs, state unemployment insurance costs goes up. And that tax range is based on your experience and how well you perform from a claim standpoint. So your cost from a tax standpoint could range anywhere between 268.80 per employee up to $1,267.20 per employee, right? Based on your tax rate. And again, the wage base and the tax rate is set by the state of New York. All right, so let's talk about some examples of clients we worked with in New York, and what we found when we audited their unemployment cost. So here's an example of a small organization, about 2.5 million in taxable payroll. And by the way, taxable payroll again does not mean total payroll. This is just how much of their employees' wages hitting that wage base would be actually taxable. So in this case, that's 2.5 million. Their tax rate was 2.1%. So they already had the minimum tax rate. Their estimated claims, right? And I'll show you how you can get this, was $9,200. And I remember this example because that was a 5-year average, right? So he took a 5-year average of what their claims are to come up with an annual claims number. And then we looked at their estimated annual unemployment taxes in the past and going into the next year, and their tax liability would be 52,500. So in this example, we have what we call an overpayment, where they're paying into the tax pool $43,300, which is significantly more than they were paying in annual claims. So this is an organization we ended up actually putting them on in our trust program and supporting them in their claims process. Generally, when working with an outsourcing service, we look at the annual claims, and we look at their claims over time. And typically we see their claims expense over time goes down because we're able to, contest claims that are contestable, identify fraud and overpayments. Again, just in the last 3 quarters, we found $100,000 strictly in overpayments for our clients in the state of New York, which is almost about $10,000 per client that we're able to recover. And this is more of a typical example of what we might find. So here's a private school that actually I was involved with early this year. This is not typical, I'll say, but we do get a couple of these every year. And this is an organization that had about, $6.8 million in taxable payroll, right? So I believe about 700 employees, and had a tax rate of 4.1%, right? And looking at the 5-year average of their claims, their estimated annual claims are only $3,750, which is really unusual. But this is a private, school that was well established, and they had very little to no turnover. So in this case, they were paying unemployment taxes to the tune of $278,800, right? Part of the reason their tax rate was so high, despite not having claims, is because they had recently left a PEO organization. So they were with a PEO and were not paying taxes through their ID. Coming out of the PEO, the state put them they had to register as a new employee. So that's why they had a tax rate, the new employer rate of 4.1. So they're looking at this and like, wait a minute, we're coming out of a professional employer organization, and we don't want to incur, almost $280,000 in tax liability, especially when we have so few claims of unemployment. So in this case, their overpayment was estimated at $275,000, right? So this is an organization that will save significant dollars over time. We ended up putting this one in our trust program. So they put a lot of that money that they're saving inside our grantor trust. And within that trust program, that money actually makes interest. We have that conservatively invested. They have stop loss insurance on top of that to, protect them should, God forbid, they have a year where they have to do layoffs. But again, over the next 5 years, likely they're going to save over $1 million just in the cumulative savings over the next 5 years. So that probably begs the question, how do I find my actual claims? So, and I can always, anyone wants it, send an example of this, but this is what they call an IA-97 in the state of New York. And it's a sample tax rate notice. So you get this every year. Um, and this one came out, this is February 9th. So middle of February to end of February, you'll get this in the mail from the state of New York, from Department of Labor. And if you see here, the top portion over here is your tax rate. So you add the unemployment rate to your reemployment service fund rate, and that gives you your tax rate for the year. So getting these in February, this will give you your tax rate for 2026. And typically you would either, if you're doing payroll in-house, you would adjust your rates in your accounting system, or you turn this over to your payroll company. Which, by the way, since I used to work for a payroll company, make sure that you are communicating this to your payroll company, because the payroll company typically has no way of knowing if you don't provide this to them. So sometimes we see payroll companies, under withhold, they'll under withhold from the employer side for unemployment in the first quarter, and you can end up with a penalty if you're not withholding enough unemployment, or they could be overcharging you for unemployment if they don't have the appropriate rate for your organization. So if you look down here at 1A, right, and 1B, you'll see here that 1A is your normal contributions credited. What that means is for last year, that's the amount of money you paid into the unemployment tax pool. So this would be your tax expense for 2025. In this case, it was 46,669.22, right? And 1B is the benefit payments. These are your claims, your actual claims for each employee that went to the state of New York, went through the process, and were granted unemployment for the state of New York. In this case, that was just under 13,000, right? So we look at these two numbers to make sure that does it make sense to consider being reimbursing. And typically what I'll say is I'll ask for, if you can get me 3 to 5 years of your IA-97, then we can go ahead and do an analysis and do a trend. Hey, based on what's happened in the last 3 to 5 years, we can do a trend. If you became reimbursing, this is what that model would look like over the next 3 to 5 years, right? Because sometimes you might have in one year more claims of unemployment than in another year, right? So we want to make sure that we have as much data as possible so we can do a good trend analysis to make sure if it really makes sense to become reimbursing. Some common misconceptions I get about this form, again, like if you look at 3, this is your average payroll subject to contributions, right? So this is how we start to ascertain how much of your payroll is actually subject to your tax, right? This is how we do our calculus in terms of what your tax liability might look like for next year based on, changes in tax rate and increases. But one common misconception I get when employers look at this is when they look at 1, right? Before you get to 1A, you look at line 1, and that says $40,000. That's your employer account balance. And what that is, that's money that the state is holding in reserve. It's an actual calculation of how much money the state thinks they need to hold in reserve to fund unemployment for your organization, right? So that is not actual money that you'll ever get back. And it's not money that you can get back, even if your organization became insolvent. But I've had many organizations that were operating on the belief and they didn't want to become reimbursing because they felt that they would lose this employer account balance. But it's strictly an actual calculation that the state uses when trying to determine their maximum potential liability from organization to organization, right? All right, so I'm going to go a little bit into, who we are and how we help organizations manage unemployment cost. And then I'll go back to the chat and I'll do some question and answer. So we've been doing this for over 30 years. We were founded in 1982 by a former UCP executive by the name of John Huckstead. And he was looking to save money for his organization. So he came up with the idea of starting a grantor trust, where as a reimbursing organization, you can set aside funds to pay and fund future claims of unemployment, right? So let's say in 5 years, you're saving money versus the tax system, but on year 6, you incur a significant amount of claims. You have a trust fund set up to pay for those claims. So essentially, you're setting up a safety net. Right. And within that trust fund, again, these are funds that are owned by the organization, but are held within our trust, right? There's a about 3.7% interest rate return. So instead of putting money into the tax system, you're able to put money aside in reserve for future claims that you can get back if that money is not used, but also make some interest on that money. So he created the first of its kind grantor trust. It's called the Joint Unemployment Compensation Trust that eventually became the 501c services or 501c agencies trust. So we started with about 25 members here in San Jose and now have grown to helping over 3,000 clients with their unemployment liability and unemployment management. So in 2016, John sold the company back to his employees. So we're now 100% employee owned. So everyone from the receptionist to the CEO, including myself, every member is an owner of the company and committed to serving our members. So our services are tremendously valued by our members, and currently we have over a 97% career to date retention rate. So that's not an annual retention rate, it's 97%. Because I like to say great service, of course, but the other reason we enjoy a 97% retention rate is because we're very careful about doing the diligence up front to make sure that one, this is a fit for your organization. We don't want to put anyone into a reimbursing program if we feel the risk is too great or they're ultimately not going to benefit over time in the savings to becoming a reimbursing organization. How do we help? So here's some ways that we help our clients. So, the first way we help nonprofits is through claims management. So our team, just in New York in the last year, helped our clients manage over 1,000 claims. So we help you audit and protest claims, and you get unlimited access to hearing reps. We'll actually provide representation at claims hearings on your behalf, right? And as I said earlier, we enjoy over a 89% win rate versus less than 35-40% average in New York. Because if you're going to become reimbursing, every dollar that saved is money that remains in your pocket as a reimbursing organization. So you definitely want to make sure you have either the right internal controls and expertise, or you're working with a great partner to keep your unemployment claims expenses low. So every one of our clients is a dedicated claims manager. We also provide a portal where you can see the status of every single claim as it goes through the process within the portal. You can manage your claims process within the portal, and you have a dedicated support person. So we're you can just pick up the phone and we can have a conversation on the status of every claim. We also provide HR support specifically around separations, right? So in terms of HR support, everything we do is to help you become more efficient with your HR department or to support your current HR provider to manage separations more effectively. And we know that, it's one of the hardest things that you'll ever have to do in an organization is to, separate or let an employee go. So many times, our HR service personnel will, get on the phone with you and discuss potential issue you might be having with an employee, potential disciplinary problem, anticipated separations, and will advise you in terms of how to go about that separation so that your organization is being fair, as well as in compliance and limiting your liability to the organization and handling that separation in a manner that's as respectful and done as well as possible. We also provide reemployment services because, again, if you're going to become a reimbursing organization, we do provide reemployment services to our clients. So these services typically offer, if you think about it, if you're going to be paying $869 in maximum weekly benefits, the sooner you get your separate employee off unemployment, the better, right? So we have tools and packages which can range from online coaching, interview techniques, and resume writing, as well as outplacement services. And this really helps save the organization money over time, as well as provide a great benefit to your separated employees. So typically, employees will find their next step, their next jobs, 60% faster than if they were on their own. And of course, insurance is a part of our program, and we model different ways you can manage the risk associated with unemployment. So if you're looking whether you want to participate in our trust account and our trust reserve program with stop loss insurance, you want to buy additional protection or go into a more fully insured program, we can model that for your organization. We try to be impartial in terms of how you fund for your unemployment. We just want to make sure that the way we are advising you to fund for your unemployment in a manner that reduces risk to your organization, that makes sense, and make sure that it's just the best fit for your organization overall. And of course, a lot of our organizations, we do stewardship reports where we look at, protestability and claims. We look at money we save for organizations over time. So we even go back to organizations if we see their claims costs increasing, we'll look at, review how they're funding for their unemployment. Even looking at like some organizations, it doesn't happen often. We've had some organizations where we'll take a hard look at it and say, you might want to consider going back into the tax system. When you become a reimbursing employer, you're out of the state tax system. You can't come back in for 2 years. But after that, that becomes an option that's available to you. But that's something that we do from a fiduciary standpoint. We do make sure to review how your organization is currently funding your unemployment process. That's something that we find because unemployment tends to be one of these cost items that's frequently overlooked. It tends to be very set it and forget it. A lot of organizations we work with perhaps haven't looked at their unemployment costs, whether they're reimbursing or tax paying in 10 or 20 years. So we recommend that organizations really look at, their current method for funding unemployment, whether they're reimbursing or tax paying every 5 years, especially now, to make sure that they're handling in the way that's saving them money as well as that's mitigating risk to the organization. And just here's some great things that we've had from some of our clients that we worked with in the past. We actually have a national relationship with YMCA and Boys and Scouting America. And here's some of the clients that we work with in the state of New York. So there's a lot of organizations in New York are already reimbursing, as well as reimbursing and working with us, such as Food Bank of New York City, Good Shepherd, and Carnegie Hall. In terms of evaluating your unemployment cost, it's pretty simple. And again, I can put this out in an email so everyone has it. But to get a cost analysis and and see if it would be a benefit either to stay reimbursing or a different way of reimbursing, or if you're tax paying and want to see if you would benefit from reimbursing, we want to look at your 941s from Q1 of 2025 to Q4 2025, right? So we get a snapshot of what payroll is for the year and an estimated payroll, what your 2026 year would look like. And if you're paying unemployment to the state tax system, you would want a copy of your IA-97. And that's that sample form that I showed you earlier that will show us what you're paying every year in payroll taxes and what your actual claims of unemployment are. And ultimately, that's going to be the biggest deciding factor. Does it make sense to be a reimbursing organization? Occasionally, we'll see organizations, they're just not saving enough, or perhaps their unemployment claims exceed what they might be paying in taxes. So your taxes will probably increase, right, to keep pace with that. But certainly, if your organization is paying significantly less in unemployment claims than taxes, then we probably should consider reimbursing. We can model some options financially in terms of risk that would look like for you. All right. So we're at the question and answer part of the program. I'm just going to go back to the chat. I'm going to look at some of the questions, and I'll make sure that while we're doing the Q&A, I'll make sure I put up my information. So, if I don't get to your question or if you want to reach out to me directly, that's my cell phone number. That's my direct email address. Feel free to reach out, or if you're not comfortable putting your question in the chat, you can contact me here. So just be patient with me when I go through the chat. I do see some questions or about the Uber Eats voucher. Make sure if you didn't get your Uber Eats voucher, give me your email address in the chat or send me a quick email and note. I'll make sure you get it after the fact. We just had an issue. We had a lot of fraudulent requests for Uber Eats vouchers, so we didn't want to send out 100 vouchers to people not attending the webinar. So we had to send them out individually. So we might have missed one or two or mistyped an email address. So we'll be happy to take care of that for you. Again, we will share the PowerPoint with you after the presentation, so you will get that in a follow-up email. I did get a question from Carolyn about, is the unemployment maximum benefit, is that unemployment benefit based on salary earned? So yeah, that is based on time spent for the organization as well as salary earned. So the maximum that I talked about of $869 a week assumes that their salary max and their time spent would make them eligible to receive the maximum amount. So that maximum amount, it can change, if depending off their part-time versus full-time and based on salary earned. I also got a question again, Carol, regarding average cost of unemployment for a $1 million payroll. Again, depends on their tax rate, right? So, it can really vary between 270 to $1,300 per employee, depending on your tax rate. So, if you look at your II-97 and take your tax rate and then take the payroll subject to your contribution, so how much of your payroll is subject to that tax rate, you can get a sense of what your unemployment tax will cost moving forward in 2026, right, for budget purposes. And that's something we can look at for you. We can look at your II-97, your payroll information, and give you an estimate. We see organizations, I'm talking to one right now that's a half a million in payroll, and they're going to increase to 1 million in payroll. So we're having conversations about, what they should budget for unemployment. They're considering becoming reimbursing. So that's, they have to understand what their tax liability is going to be versus what it would cost to be a reimbursing employer. So we help organizations kind of vet all that out up front to see what's going to work best for that organization. Nicole asked a great question. Is any of the unemployment claims burden or tax burden carried by the employees, or is it just the employers? So it's the unemployment liability is strictly on the employer. There's no part of that the employee is responsible for. So it's not like disability where they contribute to a disability services program, right, in the state of New York. So unemployment is purely an employer organization liability, whether you're funding it through the tax system or you're owning a reimbursing program. But that's a great question. I do get that a lot. Again, if you didn't get your voucher, feel free to email me. If you have questions you're not comfortable posting, let me know. What determines the tax rate? So, yeah, we talked about this a little bit. So the tax rate is really determined based on your claims experience. So there's that range of 2.1 to 9.9. So if let's just put it this way, if you have a lot of claims of unemployment against your organization, right, then you'll ultimately pay the maximum tax rate of 9.9. If you want to really go into detail how that's determined, the new business rate is 4.1. So 4.1 means the expectation is that you perform on an average basis. So the amount of claims coming out of your organization are average of what you would expect for anyone in that tax pool, whether you're for profit or nonprofit, right? And this is why the system is somewhat skewed because you'll end up paying a lot more in taxes and claims because not everyone really kind of has claims at an average rate, right? So, but 4.1 is the percentage, the tax rate assigned for an organization that has the average amount of claims. If you have few to no claims, then you'll be at the minimum of 2.1, right? And everything in between. But that's really how they decide that. So they look at your claims and then look at your tax. They look at your look at that in determining what your tax rate is, and also look at your maximum payroll subject to that unemployment tax. Um, I got one thank you for lunch. Thank you so much. We hope that everyone enjoyed the seminar. And again, if you didn't get your voucher, we'll be happy to send out a voucher. Just let us know. And I'll leave my email and my contact information up a little bit longer. Again, thanks so much for attending the seminar. I hope you found this information valuable. And feel free to reach out if you have any additional questions or concerns. Thank you very much.